to introduce our final speaker of the summit. Last but definitely not least, Mack Kolarich with Different Funds. He's a founder and CPO, and did a little bit of a deep dive into your background, Mack, and serial entrepreneur, a fantastic connector within the startup ecosystem. I know you've run a ton of workshops on how to empower founders to be successful, and I know the content that you are about to provide to everyone is going to be great and super useful. So fantastic way to end this summit. And with that, I'll pass it off to you. Feel free to discuss a little bit more about your background and Different Funds, and we'll go from there.
Awesome. All right. Well, this is going to be information dense. Hopefully folks find it valuable. I'm going to talk about kind of the deep tech investing landscape and what the challenges are there, what some of the trends are, and where are there some opportunities. So quick agenda. Let's talk about state of deep tech capital, key drivers behind these capital gaps we're seeing that scientific founders are facing. Some of the consequences we saw in the funding environment from COVID and kind of what's driving these capital gaps in terms of the way limited partners think. Where is the capital? Where can we actually find it? We tried to kind of scope it for some of the 3 days we've had here, and then some thoughts on new resources. So my name is Mack. As mentioned, I'm the Chief Product Officer at a company called DifferentFunds.com. And fundamentally what we do is we provide research insights and all kinds of support on the venture capital ecosystem, primarily focused on the people and entities who invest in those VC firms. We've done a lot of work in deep tech as kind of a result of the areas we do research on. And I'll talk a little bit at the end about kind of a resource we have for really anyone who wants to use it. It's a prototype that you can sign up for free on our site, but it makes some of this data on deep tech VCs available to you, and hopefully it's of use. So focusing in on some of the research we've done, we initially kind of got into our work in the deep tech area at the request of an organization called Schmidt Futures, who asked us to look at the state of the U.S. advanced technology investment ecosystem, assess whether there were gaps or not, and if so, why. And this has kind of led to a whole body of work subsequently, where we've looked at all kinds of things in terms of like the fundraising funnel that founders encounter working on advanced technologies, what government agencies are doing in the US and abroad. We've done a host of deep dives into specific sectors. And we're going to have kind of a roll up that I'm going to talk about here. To give you a sense, we've looked at, I think at this point, over 10,000 portfolio companies, hundreds of VC firms that are operating in this space. And let's talk about what the predominantly the US environment looks like today. So I'll blaze through some of these slides because they're going to be pretty redundant. This was our definition for deep tech. It's something that's really fundamentally powered by ongoing R&D. It has real IP. It's science-driven. These are the companies that we've been talking about the last few days. So this isn't anything new. But we scoped this definition off of a host of experts we interviewed, because there is a range, of course, in terms of what people think deep tech means. The deep tech, or as the Europeans are trying to phrase it, the science equity ecosystem. This will look familiar to many of you, but it's very complex. As a kind of a quick snapshot of the way we see it, on kind of this horizontal plane, we think of it as a solar system. On the horizontal plane, we see the facilitators and enablers, basically the government, university organizations, and in some case, private sector, such as BMNT or Luminary Labs, or I would put like Activate there. They're working at the earliest stages of supporting scientific founders and helping shepherd the tech to kind of a commercial environment. On this vertical plane, and they, occasionally will intersect, and a lot of times they don't. They kind of all operate in their own little orbital patterns, are the investors and donors and customers. And so, government sits here again if they're actually investing or have contracts. But this is where the VCs and corporates show up. And then, of course, we have these storytellers as well, which are really important in terms of kind of reinforcing the mission and helping ultimately sell the vision of deep tech. So, more people want to invest in it, government puts money into it, so on and so forth. And again, as you all know, the investing cycle from kind of the classic venture ecosystem for deep tech is a little bit different. There's a lot of variation, of course. We're all working in different areas of science, but typically there's longer development cycles. It could be more capital intensive up front. But one of the things we think is a huge asset is that you can have real defensibility through intellectual property and technical moats. This is something that a lot of other startups don't have. And for founders in the room, this is a really powerful selling point to potential investors. Remind them of that power. If you get that product, you probably don't have to drop $20 billion on marketing like Uber to try to get to a lot of customers. It's going to be more of a predictable enterprise sales process. So what did we find in kind of our initial deep tech report? So this is data from like the most recent period when we had it. It's kind of still tracking this way. I'll give you an update in terms of what we're seeing in 2020 and 2021 in a few slides here. But we fundamentally found, there's a capital gap. There's in the US in 2018, $131 billion went into startups in general. About $5 billion went into AI. There's a little bit of overlap here, about 20 into life sciences, and that left 12 for all other categories of deep tech. And about half of that went into autonomous vehicles. That's not a lot of capital for a lot of sectors and fields of innovation. So this is kind of how we see the breakdown of where the gaps are. And there's kind of 3 slides I'll walk you through here. It's really, we see 3 specific gaps. Now, as a founder, you may encounter none of these in your experience. You may encounter all of them, or you may encounter one. Everybody's experience is going to be different. But to give you a sense of the overall landscape, this is kind of what it looks like and kind of why it exists. So the first really major gap we identified is when government and grant capital starts to phase out. So the cyber dollars, you used them up, and then, okay, where do you go next? There's not a lot of VCs that are investing that early. There's a few, but they're limited in number. Very few corporates are active. There's not a lot of angels. And so this is really this first gap, and it's really concerning. It's something we've actually been talking to folks across the government for a while in terms of ways we could address this in the US. But it's certainly a hurdle. As companies kind of continue in their growth trajectory and they start to think about seed or Series A kind of raises, it looks a little bit different. This is where we started to see a lot of the VCs that do invest in advanced technology start to enter and start to be more active in investing in companies, which is great. But generally, in our perspective, we think there are too few VCs. And they tend to be undercapitalized. These funds themselves oftentimes struggle to raise capital to deploy into the companies. And there's a host of reasons, but that means there's less dollars to go around. And the corporates, the CVCs, sometimes they'll be active, but it's limited at this stage. Lastly, the last big gap we see is kind of the growth stage or Series B gap. And here it's really kind of driven by a couple factors. One, there's not a lot of growth stage deep tech focused VCs. Most of the VCs that are doing these really big checks tend to be generalists. And as a result, they're evaluating the deep tech startups against all the other startups they might invest in. And so this is where we get into this kind of Series B KPIs. Your performance indicators are going to be compared to other potential investment opportunities. Corporates definitely do get more active, which is great. And we're seeing this grow even more so over the last couple of years. So that's even better, but there's still a limited number. They may be investing across a host of different types of companies, and only a subset are actually doing something in advanced technologies. So what's driving these gaps? We'll talk about that, and then we'll get to kind of the current state of things in terms of where the capital really is. So let's talk about the pre-seed. There's been a lot of talks about this, so I'm sure this is nothing new, but America's R&D budgets from a federal standpoint have been dropping for many, many years until hopefully this year. We'll see what happens with the Innovation and Competition Act. It could unlock a lot of capital, looking to fundamentally match what China's doing. But that's challenge number one that contributes to the limited budgets. Secondly, Universities, a lot of times people will point to universities as a great channel or conduit for deep tech. But one of the things Boston Consulting and Hello Tomorrow found, I missed their session, but they might have covered this, is that universities are really an imperfect mechanism for that. They're incredibly important for basic research, absolutely, but they don't have a great track record at doing spin-outs or tech transfer. And I know the Innovation Competition Act has, I think, $4 billion earmarked for support of tech transfer. I have no idea what that actually means. Be curious to kind of see how it plays out. But it's an interesting thing to bear in mind. Universities historically have had a lot of challenges with getting that IP into a commercialization friendly kind of format where the private sector is really willing to invest in it, with the exception of life sciences. And so this further contributes to it. There are some VCs and others who kind of help rethink this and help negotiate tech transfer agreements. There's also folks like Cornell Tech who are rethinking what the terms are for founders, and they're trying to help tech transfer offices to be better and license IP in a founder-friendly format. And then there's the CIBR program. Again, this is kind of the most recent relevant data when we were looking at it last fall. There's some kind of data challenges in pulling this out of NSF and whatnot. But it's kind of considered America's largest seed fund. It's a huge font to give you a sense. In comparison, there was $3.1 billion that went into CIBR grants in 2018 versus under $1 billion, as we calculated, went into deep tech seed VC. So CIBR grants are a much larger portion. Now, not all that money is going to startups. And we know that. In fact, in some cases, 70 to 80% of that money is going to CIBR mills, which tend to not actually build any kind of products. It's something that the agencies are working on. They're aware and they're evolving, which is great. But this is kind of that chief source of capital, and it tends to dry up a little too early in our perspective and from what we've heard from a lot of folks in the investment ecosystem. This is a snapshot of some analysis we've done of some of the CIBR agencies and compared it to Techstars and Y Combinator, just to give you a quick sense. Mind you, this data is from fall. I haven't had time to update this. So the programs are changing, they're evolving. That's great. They're going to fix some of the issues that they've struggled with. That may create some others. The big takeaway, and we heard about this earlier with the government folks, Jason and Art and company, it can be hard to navigate. That's not to say you shouldn't do it, but I think you need to be aware that this is not necessarily the easiest thing to go into. Like NASA has a 401-page solicitation document that you basically need to read through, and then you actually have to build your application. That is time consuming. If you get into the program, amazing, it's hugely helpful, but it does have some challenges. Now, in the early stage environment, this is where the VCs come in. So let's talk about kind of where we're seeing the capital go and what some of the dynamics are there. This data is from MIT's, I think it was the Tough Tech Landscape report they published a couple of years ago. These are PitchBook's categories. I think they worked with them on that, pulling startup data. Here, the main takeaway is nothing that we don't know, but you can see where the capital's going on the right, and then the left breaks out kind of other areas. It's going to life sciences. It's going to AI and ML, which is messy. Some of those companies are actually advancing what's possible in AI. A lot of them aren't. And so we probably wouldn't consider them deep tech. They're more kind of, an application of something that's pretty well established. And then AV, at least in 2018, took a ton of capital. And these other categories, ag tech, advanced manufacturing, materials, they face serious capital challenges. This is all better. We don't have updated numbers. Be awesome if MIT did an update on this. As we see it from an investor standpoint, for investors in the room, we think this makes these other fields of innovation either more fairly priced or underpriced. So there's some arguably investment arbitrage that it's a better investment opportunity versus some areas that have crazy valuations today. The nature of deep tech VCs, what do they look like? Most of these VC firms are what's called emerging managers, which means they're on their first, second, or third fund. And the nature of emerging managers is they just always have a harder time raising capital. They don't have this big established brand. They are not as well known to the LPs that will invest in their funds. That means it's more challenging to raise capital. Oftentimes it'll take them longer. We did see some acceleration in fundraising success with bio-related deep tech VCs for very obvious reasons in the last year. So that's great, but we haven't seen kind of a similar acceleration elsewhere. One of the other things we did in our initial research on deep tech is we scored the portfolios of these VCs to assess whether or not they're actually deep tech investors. This came up because we were meeting with a fund early on in our initial process that was positioning themselves as a deep tech investor. But when we kind of dug into it, we realized they were basically investing in the equivalent of like consumer Roombas to vacuum your floor. We didn't really think of it quite as the way most of the science industry sees deep tech. And so we kind of felt like, well, are they like science washing their thesis? So to answer this, we figured out which VCs are proactively investing in advanced technologies and which ones aren't. We didn't score the entire US landscape because that's like 1,800 firms, VC firms. We scored only VCs that at the time were either positioning themselves as deep tech investors or other people were telling us, hey, we think these guys are big deep tech investors. And what we found was kind of this breakdown on the left. You can see the distribution score. VCs with 80% or more of their portfolio that were considered by the community as deep tech was about 23% of firms. You tend to find these are either specialist VCs or like kind of they just say, we just do all kinds of deep tech. And then there are some that are just not really doing it. There's 0 to 10%. That's about 10 or 20%. That's the kind of the dark 10% part of that pie chart. These VC firms tended to be generalists, tended to be bigger funds where they might have one partner who's very proactive in advanced technologies, and they're the ones sourcing the deals. But the rest of the partners could care less. And they kind of let that deep tech partner make those deals. And in the middle, there's a wide range. One interesting insight we saw from this was the more deep tech focused a VC's portfolio, the less capital they had to deploy. That means less capital for scientific founders, and that again contributes to this capital gap. That's what this chart on the right is saying. The more advanced tech your portfolio, the less capital the funds are typically able to raise. Now, Series B, this we've mostly covered, but there's few growth stage deep tech funds. We'll see more over time as some of these smaller, newer funds build kind of this track record of success and start to scale and raise larger and larger funds like Lux and DCVC have been able to do. We'll see that continue. That's good. We need a lot, but we need a lot more. There just aren't nearly enough. The other aspect mentioned here was the KPIs. Being assessed on your growth and acquisition performance tends to be a challenge if you're raising from investors who don't get the deep tech opportunity. There are some who do, and this is growing. But if you're raising from a broad fund like a Kleiner or Sequoia, there's a very good chance that they're debating whether to invest in you or in the next Airbnb. And it's the unfortunate reality. This is where corporates can step in and be really valuable strategic partners because they get what you're actually trying to do. Now, what kind of contributes to this? Let's talk about like the LP or the limited partner appetites. This is the money behind the money for you founders. Understanding this is helpful in terms of getting a sense of why VCs act and behave and invest the way they do, because ultimately this is funneling it. Really what it comes down to is there are not a lot of LPs who really understand deep tech. They think, we believe it's a misperception, but they think that they can make more money investing in software pure plays. A lot of them are not very comfortable doing the due diligence on the VCs who are deep tech focused. They just don't know what questions to ask. This is an area where we kind of step in and provide advice and perspective and help them there. And corporates are starting to wake up. That's good. In some cases, I know with like energy tech funds, corporates in a lot of cases are more than 50% of the LP capital in the energy tech VCs. We think more of this should exist. We've talked with some very forward-thinking corporations in other industrial areas. Some are already doing this. More are starting to ask questions, but it takes time. I think one of the big takeaways for investors in the room, though, is what we've seen is of very well-known, sophisticated LPs who are active in venture. A good number of them are also very active in deep tech. So I would pay attention to that if you're not already. I think if you're in this room, you don't need to be sold to. So I think we're all like-minded, but worth bearing in mind. What drives this? Fundamentally, it comes from like Wall Street norms around maximizing returns. If I'm a pension manager, I have to meet my obligations to my pensioners. I'm expected to hit, let's say, an 8% return on my overall portfolio. So venture is just one aspect of all these different assets I invest in. And I may already see venture as a really high risk, high fee asset. And if I then am starting to look at deep tech, I may see that as even higher risk. And I may not have the time internally at my team, at my endowment or foundation to navigate this world. So all this just kind of contributes to the funding capital gap we see with a lot of these deep tech VCs. Now, COVID kind of accelerated some of these challenges, unfortunately. We're getting some great positive tailwinds as well, but let's talk about the bad things first. So in 2020, we saw the fundraising environment for smaller, newer firms get drastically more challenging, with the exception of biotech. Roughly, we saw an 80% drop in capital raised in 2020 for funds under $100 million versus in 2019. That is massive. Basically, what LPs did is they predominantly fled to these big established brands because they were worried. They didn't know where to invest. And a lot of them had a mindset of nobody got fired for hiring IBM. Questionable whether you should be or not, or for, say, hiring a McKinsey. So they went with the easy choice. We're seeing this start to thaw, I think, a little bit now. There is corporations paused on their CVCs in March of 2020. They have basically re-entered, so that's great. And LPs are starting to ask better questions around deep tech and emerging managers. But another way to look at this is that in the US, 12% of the VC funds across the country took 70% of the capital. These are all the big established funds. Very few of them do much in deep tech. A few do. We also saw, just another way to look at the data, a drop in the number of new emerging managers that are able to raise. That's basically the takeaway. SPACs been really interesting area of conversation over the last year. For those who haven't followed closely, SPACs are basically a way to go public through kind of like this little reverse merger mechanism. It's basically seen as less onerous. A less onerous way to IPO with some easier kind of reporting requirements. There's a good number of people in the ecosystem who are very excited about SPACs and their ability to kind of support deep tech companies going public or exits for the investors. Ginkgo said they're going to go public via SPAC. I don't think that's happened yet, but there's some risks here because some, like say Lordstown, went public this way as well, and we now have seen some very negative research come out. So I don't know. It remains to be seen whether this is actually good for the deep tech community or not. In some ways, it's great because it shows, hey, No, this is not a 20-year time horizon from when I've started my company to going public. We can go public in, say, 8 years or 11. We can be on that typical venture capital timeframe. But in other ways, if these companies that have gone public don't do well, that's going to be an area of concern and could hurt you as founders. We're just going to have to see. It's at least a nice component of the toolkit to have as a founder. It's an option and it's a story you can try to tell. Lastly, here we've seen rising government priorities around climate and science. I'm sure you've heard quite a bit about this already. I think it's really exciting. It's a huge amount of capital that could be brought to bear on some major problems. I am wondering to what extent we'll be able to have capital focused on the commercialization aspect versus just pure basic research. They're all important, but we think a lot about, okay, well, how do we actually turn this science into like a real product? And that's the question that the private sector is asking. There are some aspects of the Innovation and Competition Act that I think will help with that. I think the government needs to do more. With China, you probably have followed their 5-year plans. The 14th one, which they basically passed, I think, in March of this year or ratified or whatever the term is that they use, it's focused on scientific self-reliance. So huge amounts of capital are going in, and that's what's driving our activity here in the US. And Europe is being increasingly proactive. They have a stereotype for being slow moving. This is certainly true in some of the areas we've looked at their deep tech investments, but they have some interesting programs that we don't have here in the US. They have, for example, the European Investment Fund, which is actually government capital to help invest in these deep tech VCs as one of those first checks to convince more private sector LPs to follow. All right. Now we're going to talk about where the capital is with a bit of a lens on some of the focused areas of this conference. So in the US, this is a map we pulled to roughly give you a sense of kind of where the deep tech capital is based. No surprise, there's a lot in the San Francisco Bay Area, but it's not all there. It's all over the country. These are VC firms on these little dots. They are relative sizing. They all look small because of the way our map system scales with San Francisco. But if we took out San Francisco, you'd see a bit more variation in terms of number of firms and amount of capital. It's all over though. And part of what's driving this geographic distribution is the kind of recognition of investors that they want to be close to the sources of IP, where the talent is, and where the industrial partners are. And there's only a small subset of Fortune 500s in the Bay Area. There's only a small subset of researchers in the Bay Area. It's all over the country. And so I think this is actually really promising. There's over 50 markets across the US that are home to at least one VC that is proactively investing in deep tech to some degree at least. Same goes for Europe. That, again, there's a lot in London. There's a good amount in Paris, but it's all over. There, again, are over 50 markets across Europe that are home to at least one deep tech VC. We're a little bit earlier in our research on Europe. We're kind of processing this. One of the things we have found, though, is that while there are fewer funds overall in Europe, fewer VC firms, deep tech funds are a much higher ratio of those funds. We figure about a quarter of European VCs are actually deep tech investors. So that's a much higher ratio than what we've seen in the US. They do tend to raise a little bit less capital than even here in America, though. From a continental perspective, here's where we're seeing VCs claim to invest. This is kind of targeted investment areas. These are the most common. So no surprise, AI and ML, we've got Europe on the left and US on the right. AI and ML are the most common sector focuses. A firm may invest in multiples of these, by the way. These are not exclusive. It otherwise kind of trends with some differences. Europe invests more in sustainability, which I think probably won't surprise any of us here. We're investing more in robotics, and if the kind of reformed Endless Frontier Act passes, we'll see even more of that. And then ag tech is an area in the US that we are much more active than the Europeans are. Within some of the kind of focus days here, I tried to pull some data on this. This data is, I think, from the fall. So, the numbers have probably changed a little bit. So take it with a grain of salt, but it'll be roughly accurate. So in the US, we actually did this for NASA, and we looked at what percentage of deep tech VCs had invested in space tech. And space tech is a fairly narrow definition. We tried to pull other related tech like energy and compute materials, which does really matter for space. But we found that 75% of the deep tech funds in this country had never done a single space tech deal. That's quite the divide, versus 30% of deep tech funds had never done, say, an AI ML deal, at least one that's proactively positioned. So, and we also found about 2% of these 400 or 430 firms had done 5 or more. So a very small component was proactively investing in space. The same is true here for energy. It's very comparable, which I think is interesting. You have a little bit higher number, but not much of VCs who have done 5 or more deals, probably about 2.5. But again, it's a challenge. Lastly, we don't really track blue economy internally. We've tried to come up with some quick proxies here. So just for the purposes of this, we did climate. I realize it's not perfect, but this will give you a sense of kind of where climate fits into the equation. That's a lot more activity. 39% of U.S. deep tech investors had never invested in a climate deal, and 8.6% of them have done 5 or more deals. So there's a fair bit more capital flowing here, and I think this may not surprise folks in that regards. The other thing we did is we tried to map where these firms are by space, energy, and then here we did a slightly different proxy on blue economy, which you can see in the bottom left with that asterisk. We talk about which tags flow into this. So the blue economy, again, will be probably overestimated, I think. And the difference here is just based off of how we have the data structured to do this on our end. But this will give you a little bit of sense of where the capital is. Space is much more segmented in terms of geography. Energy is very distributed, and kind of blue economy is interesting because the Bay Area has less of a concentration. Other regions punch above their kind of relative weight. And so I think that's really interesting. One thing to bear in mind, though, is COVID threw all this out the window. People invest everywhere. People still like to invest close to home, but increasingly funds and other investors are willing to do deals outside of their immediate geography. And I think that's overall a big win for the community. Lastly here, and then I can jump to Q&A. A couple thoughts on kind of some of the resources and tailwinds we are seeing. This, again, kind of covered here and probably not really new to any of you, but the simple fact that government is increasingly focused on supporting R&D, I mean, that can't be understated. To truly grasp the magnitude of billions of dollars flowing in, not just from the US, but from Europe, from Israel, from Latin America. There's actually a lot of interesting work in bio coming out of Argentina and so on and so forth. And then, of course, China. This is trillions of dollars. And I think from a humanity standpoint, that's going to be great. There's always competition concerns and geopolitical concerns and how the technology is used, of course. So there's a lot of fear and uncertainty. But I think generally this is good. I mentioned we're not quite sure in the US, at least, the level of support we'll see for getting tech out of the lab and into the market. I think we need a lot more than we currently have scoped in the bill as it is, and there are some other bills that may address this, but that's powerful. I think the fact that LPs fundamentally. Wall Street is getting serious about climate tech, means we're going to see a lot more capital flow in that direction. Corporates are increasingly recognizing that they are behind on internal R&D and they're stagnating. So they're trying to reinvent either through partnerships, acquisitions, proactive investing. As a founder, you got to navigate that carefully. We heard that from Oren, but that's an asset. And again, some of the smartest money that invests in startup companies is proactively looking at deep tech. So that's a good signal. We hope more LPs will follow. Just to end it, this is kind of a snapshot of our little platform we have that's on, again, differentfunds.com. So we track 2,500 VCs across the US and Europe. We're increasingly expanding our data coverage globally. This is always an iterating process for us. We took initially about 370 US firms, and mostly US, and put them into this prototype. Now, it's a prototype. It's not the best. We just wanted to get it out there. We're using it to learn and inform a much more advanced research tool that we're in the process of building. That's going to take some time. But we wanted to have this data available to anyone who wants to use it. So if you're a founder or a government agency or an investor, it's there. You can sign up for it. We're going to update the data over time. We're working on an update currently to the data set with kind of either new fundraisers and fund vintages. We're also going to add a number of new funds to it. And then probably the next set will probably be European deep tech funds. That might take a little bit longer. But that's out there. It's a resource available to anyone who wants it. And with that, happy to take any questions if there are any.
That was awesome. I need to do a much more deep dive into kind of the website to check out all the data that you have. That's fantastic. And for the European deep dive, check out Hello Tomorrow. They spoke on Tuesday. I think they have a lot of great content for you. For one question that came in, it's specifically focusing on policy shifts internally within the US. So all of the Frontier Act, what are you tracking and seeing in terms of government pushing innovation around deep tech to ensure that it remains the main competitor in the deep tech space?
So, I mean, it's a good question. And I will say I'm not a policy expert. We follow it to some extent. To the extent where we have a temporal capacity, or if clients ask us to look at it. I think the funding for basic science is huge. There's going to be a lot of capital that flows through universities. Again, I mentioned on the one slide related to universities, that's both a huge asset and an area of concern. I don't want it to be the exclusive channel for capital for deep tech innovators, because universities aren't the end all be all. The $4 billion that's earmarked for tech transfer support, I haven't dug into yet what that is. That's potentially huge because we have a lot of problems with tech getting out of the lab. I think Georgetown published a very thorough analysis of the success of various different tech transfer offices across the country. I want to say they published that in January of 2020. It is worth a read if you're a founder or you're working in that space. So remains to be seen. And the tech hubs is another interesting area. I think there's about $10 billion in building kind of regional tech hubs to diversify the industrial base really across the US. And I think a third of that is supposed to go to rural areas. I don't know what the definition of rural is, but as many of us know, there's great researchers in large state universities all over the country, and sometimes those state universities are considered to be rural areas. So I think that's potentially really powerful. One area we've had some conversations with folks in Congress over the last few months is getting the U.S. government to set up I see it as almost an equivalent to the European Investment Fund, but we're calling it kind of like a national deep tech capital fund, We think that's important to have as a resource to fill gaps, to fundamentally fill funding gaps at both the startup and the fund level, where the private sector just isn't stepping in because the risk is misaligned. One area, which I know there is some earmarked capital in the kind of the what's the acronym? It's the USICA, U.S. Innovation Competitive Act, Competition Act. Within USICA, there is some money earmarked for this in some capacity, but we think a $1 billion kind of national deep tech capital fund would be really powerful in terms of filling project finance gaps and then backing funds that are really out on the risk spectrum, or startups that are really out on the risk spectrum. One example area would be materials. Materials really struggles to raise capital. When you crack a new material, it opens entire new economic frontiers. I think that's an area where the government could do more.
Absolutely. Yeah, I think following what USICA is doing in comparison to what other countries have already done will kind of be enlightening as it continues to unfold. Now, I guess we have about 4 minutes left, but I'd love to hear, here's a great question. If you were to quit everything you're doing right now and start a deep tech company, what specific sector would you look into focusing on? Or niche, I guess.
It's an interesting question. I mean, some of this is challenging to answer because you have to, as a founder, you have to be aligned with your passion, right? And you have to love the subject matter. You have to really like the customers. I think that's something that Steve Blank is a big proponent of. If you hate your customer, you're not going to succeed. So bear that in mind. I think the two areas that interest me the most right now would be biology plus tech, not life sciences or pharma, but the application of biology across a host of different industries. I think that's a fascinating category of innovation. I have a personal interest in agricultural innovation just from growing up in the Midwest. I kind of just stay up on that, so I could be interested there. The other area would be I would if I could find the right technical talent, because that's not me, I would be the business talent on this, would be something in material science.
Well, then in the final 2 minutes, I actually also agree. I think biology plus tech would be where I would try to go in the sector. For the final 2 minutes, what final advice would you give to the founders that are on this call for them to really succeed in scaling up their business and making sure they're as successful as possible?
Sure. So you need to really think about your team. And this is one of the most common reasons given by VCs for why they really liked a tech or really liked, say, a scientist with a set of IP, but they didn't ultimately invest. You need to have the complementary business talent, and you really have to think through that carefully. There are a lot of VCs who have told us they did not invest a deal because they didn't think that the business talent was basically in the founder role was up to par with the task. So I would think about team construction very carefully. There's a lot of great ecosystem partners who can help you think through that and help you, if you're a scientist yourself, can train you to think at least a little bit more about the business sides and make some better decisions. But ultimately, find the right partners on that. And then I would think, secondly, again, particularly if you're a scientist, ultimately, what's the application? How do you actually make money? I know you care about the science, but you got to think about how you make money and try to translate that to the best degree you can in terms of market opportunity. We see a lot of companies fall flat on this as well. And VCs are really relentless. They want to see the commercialization potential. I get like sometimes it's not quite clear, but think about that as much as you can, because that will help you. Even if you're never going to have all the answers, you will always have some form of risk. But the more you've thought about it, the more you can talk about it intelligently and demonstrate you're at least aware and asking the right questions. That's going to make investors in you feel more confident in backing you.
And with that, I think that's all the time we have. Thank you so much, Mack. That was fantastic. And I know I've gotten some requests for presentation, and all of the data that you provided, I think, will be very useful for a lot of the founders, the ecosystem actors, even the investors in the call. So I can steer them towards your website. And if you have anything to share, we'd love to get it out to the attendee list.
Sure. Sounds great. Yeah. DifferentFunds.com. And we have some additional research we've published in our blog, which is the insights section. So I didn't even get into that because that's a whole other other conversation, but hopefully some of that's helpful.
Absolutely.